Welcome to our December 2024 quarterly macro and market update with our Chief Investment Officer, Michael Dow. I am Julien Frazeau, your Deputy Chief Investment Officer at Pointe, and it is my pleasure to be your macro and market moderator today. We've got a lot to cover, but before we bring Michael in, just a couple of housekeeping items. So we budgeted up to 90 minutes for this webinar, and we have more than 60 slides to cover. We also get a lot of great questions for our audience, and we want to make sure that we have time for Michael to address as many as possible. So we already got a lot of questions, but if you do have questions and you haven't submitted yet, you can always type it into the Q&A box at the bottom of the Zoom screen, and we will address it throughout the course of the presentation. Also note that we are making a recording of this webinar available at beaconpointe.com/videos approximately 24 hours after the conclusion of today's live event. Okay, so what's on the agenda for today's call? In the first section, Michael will talk about the impact of the election and expected policies on the economy and the markets. In the next section, we will do a deep dive into growth, budget deficits, and the national debt. In the third section, we will discuss the current state of the US economy, inflation, and the Fed. In the next section, we will delve into US exceptionalism. Are allocation to non-US equities necessary to capture the entire global equity opportunity set and improve the efficiency of portfolios? That's the question we'll try to answer. And as usual, we will wrap up the webinar on how to position portfolios for 2025 and the radical shift in policies with Trump 2.0. Okay, so without further ado, let's bring Michael in. Michael?
Julien, thank you very much, and thanks everyone for joining. I always start with this same slide because I think it's important to clarify exactly what we, as your investment team, thinks is the most important thing when trying to position portfolios. There's a lot of noise, and we're trying to figure out what the signal is, and the signal for investing comes down to what the Fed cares about. And the Fed cares about where you are in the business cycle. Are we going to have a recession? Are we going to have an expansion? Their primary mandate is related to price stability. So the Fed cares a lot about inflation. If inflation's high, they're going to try to slow the economy. If inflation is low and the unemployment rate is rising, they're going to support the economy by lowering interest rates. And then it all comes back to the equity market and corporate profit. So if you know what the Fed's doing and where we are in the business cycle, and you can make some judgments about the direction of margins and corporate profits, that's really all there is. There's a lot of things we could talk about, but almost everything we do when we're trying to make money for clients and protect on the downside relates to these three main issues. So let's try and start with the conclusion, and then we'll dig into the details around our outlooks for the coming quarters. First of all, are we going to have a recession? The answer appears to not. That doesn't seem at all likely. There's no imminent signs. Very little stresses in the consumer, very little stresses in households and corporations. There doesn't seem to be any imbalances in the economy that would cause a recession in the near term. There's always scope for either a policy mistake by the Federal Reserve or some kind of an exogenous shock that we're not anticipating that might throw the economy off track. But it's been Goldilocks for the last 6 or 8 quarters, and it looks like we're going to continue to have modest growth going forward. So no recession, and a potential in coming probably months to be able to fully declare a soft landing. That can't be done until the Fed normalizes interest rates. And we're still in a tightening mode. The Fed is not accommodative and they're not neutral. They are trying to slow the economy because interest rates are a little bit higher than their neutral rate. Having said that, they are moving interest rates lower because they're seeing a few cracks in the labor market. So we're still tight. We're not back to neutral. We're certainly not accommodative, but the Fed's moving in that direction because they can declare victory on inflation. I'm not sure that that's entirely true. You might get a little echo of inflation. We seem to see some inflation stickiness, but as it stands right now, a soft landing would be the base case. In terms of the inflation, the Fed we just talked about, they're in their cutting cycle right now, for sure. We've seen the peak in Fed funds for this cycle. We're likely to go lower next week. I'm pretty darn sure they're going to cut 25 basis points on the 18th. They're probably going to cut 2, maybe 3 times further in 2025, barring a recession, in which case they would cut a lot faster. But we're in the rate cut cycle, and it's going to and Fed funds are going to go lower. And until we get a recession, corporate profits seem to be resilient, particularly here in the United States. And Julian's got a lot of data on the growth of corporate profits here in the United States versus non-U.S. stocks. And it will make the case for, while valuations are contrary to what I'm about to say, that the U.S. is an exceptional place to invest and has been for much of the last 10 years. So all of these questions, this is how we figure out where to position the client portfolios when we're trying to make money and for you and for protecting on the downside. These are the things that matter. A couple of things that aren't on this list, I think it's important to remember. CNBC is not an input into our investment process, shouldn't be high on your list of things to think about when investing. Noise, there's tons of noise out there, shiny objects, meme stocks, other things like that. There's no reason to consider those for longer term investing. They might have some implications for short term investing, but that's not what we're trying to do here. So we can safely ignore a lot of that. So we started the agenda with the election. The election's over. It was a red sweep. What are the implications? What does it mean for the economy, inflation, debt? These are all the topics that I think most investors are primarily focused on. And I think it's probably important to first level set and see just exactly where we are in the whole thing. So what do we got here? We've got, this is equity asset classes ranked by 1-year performance and fixed income asset classes ranked by 1-year performance. And you've got the 3-year here just for reference. Here in the blue, I'm just highlighting the fact that in the last year, the only place to be would have been growth stocks, whereas value stocks are down here at still not too bad, almost 30%, but with growth at almost 40%. Tech and communication services and consumer discretionary is the place to be. In terms of the S&P, U.S. stocks versus non-U.S. stocks, it's been a triple. S&P in the last year, almost 34%. This is through November 30th. And in the last 12 months, the MSCI ACWI ex-U.S., all the non-U.S. stocks have been up about 13%. So again, to Julian's later discussion on U.S. exceptionalism, clearly that's been borne out in the numbers. In terms of bonds, I want to highlight 2024, or at least the last 12 months. This is 12 months through November 30th. So pretty much a lot of this is year-to-date data. It's driven by year-to-date data. The most profitable trades in debt were in the riskiest debt areas. So emerging market sovereigns and U.S. high yield returning exactly the same, just under 13% over the last 12 months, whereas other things have returned obviously less. The U.S. dollar is up 5% in the last 3 years. You still have some negative numbers on the broader bond market for the last 3 years. That's a result of the horrible 2022, which we don't want to revisit. We're not going back to 2022. Interest rates may stay higher, but we're not going to get the kind of return profile that you saw in 2022 in bonds because we're starting at a much higher yield level. It's important to remember 2022 was a once in a generation kind of a starting point with very, very historically low interest rates, nearly 100 and 200-year lows in interest rates coming into 2021 and 2022. So no surprise we had a tough 2022 in bonds, but it's the riskiest bond market areas that have responded. Here, let's talk about what's going on in the markets, some of these more risky assets, pre-election and post-election. And what we saw going back to the middle of September of this year, so 6 weeks out from the election, it started to become clear that the probability of a Trump winning the presidency was increasing. And as a result, things like Bitcoin, small cap stocks, the dollar, gold, even 10-year yields all went up. Bitcoin up 26%. 10-year yields went from 350 to 450 basically, so up 20%. Small cap stocks were up 9%, particularly in the last week before the election. The dollar has been rising because interest rates look like they're going to be higher, and gold has also done pretty well in this environment because it appears many of the policies might be inflationary, which we're going to dig into in some detail in a sec. Subsequent to the election, which you have on the left side here is the period from September through November 5th, and then you've got November 5th through December 10th on Wednesday. So what happened post-election? You got a bit of a, maybe it's a buy the rumor, sell the news kind of a thing. All the risk assets that were up have kind of moved sideways, although the dollar is up another 2% since the election. And Bitcoin's been the star here, given the potential for some deregulatory relief and support. A lot of crypto money went into the Republican campaign, and there's likely to be some interest in a return on that investment. And that would be, that's caused a lot of the euphoria. So since September, you had September to November, Bitcoin up 26. Since November 5th, Bitcoin up another 25%. So it's important to know what this is all about. Assets that will be perceived to benefit from the new administration's policies began to surge with the increasing likelihood of a Trump victory. A red sweep was not contemplated, but I'll talk about what the constraints in the red sweep are in a sec. But things have faded a bit with the exception of Bitcoin since the election. One of the things that I think we need to really focus on here is not only was it risky assets, but also assets related to the budget and the budget deficit that responded to the increasing likelihood of a Trump administration. And the number one most important price in the world is U.S. Treasury 10-year yields. So 10-year yields, which reflect, which almost every other asset price is priced off of, as I mentioned, the most important price in the world, surged from the time that it looked like we were going to see a Republican victory in the White House. And that surge is a result of concerns over the debt and deficit. Julian, question.
Yeah, just a lot of questions from the audience about Trump policies and in particular with regard to tariffs and immigration and the impact on the economy and inflation. And I think you're going to address that in the next few slides. So just previewing with a lot of questions. That's probably the number one question we got from a lot of people.
We'll spend some time on that then, and I'll roll right into that. I just want to say some of the pro-growth policies, some of the risky assets that have done very well, that's the good news. But there isn't any free lunch here. Some of the policies that are reflected in riskier assets going up, Bitcoin and stocks, et cetera, there's a cost associated with that. And the cost is damage to the budget deficit because of tax policies or other policies that are likely to do some damage to our fiscal dynamics and the debt dynamics and our fiscal and debt sustainability. These are issues that need to be considered when implementing some of the policies, and they will be considered by the administration. Again, just because it's a red sweep doesn't mean you've got a clear playing field and you can just run go from one end of the end zone to the pitch to the other end of the pitch. There's going to be obstacles and there's going to be constraints, and we'll talk about those in a sec. But let's summarize exactly what the policy priorities are that have been articulated during the campaign, and they fall into these 5 major categories related to trade and tariffs, tax policy. This next coming year, 2025, is the biggest year in tax policy since the creation of the income tax in 1913. If nothing is done, and by the way, given the election outcome, plenty will be done to extend the Tax Cuts and Job Act rates from 2017. So we'll talk about that. The regulatory environment is likely to get a little easier for businesses to work in. That's a pro-growth policy. In terms of immigration, there's been a lot of talk about relatively extreme policies, including deportations of immigrants, illegal immigrants in the interior of the country, as opposed to simply just closing the border. And a lot of those policies are likely to face, they're going to need congressional action, not just executive action. And I'll talk about what can be done and what can't be done in a sec. And the last one, and I'm not going to talk too much about the loss of potential Federal Reserve independence, because I just don't think it's a credible policy. The White House has put out a memo last February, March, and then Trump has talked about wanting to get involved in interest rate decisions that the Federal Reserve makes. That's not part of the mandate. The Fed is independent by law, and the chairman of the Federal Reserve cannot be removed, but for a cause. And so far, there's been no cause to move Jay Powell on, and he will serve out his term, and it will expire in May of 2026. So that's a date to keep an eye on when a new Federal Reserve chairman is going to need to be appointed. But here's a summary of the policies. This is in the paper. This is not new news. How it makes how it impacts macroeconomic outcomes and how it impacts markets will be the subject of the next couple of slides. But the first thing I want to mention is some of these things can get done, some of these things can't. Some of these things are negotiating tactics, and some of them are truly goals of the administration. And here's what it needs to take to get some of these things done. Trade policy is almost exclusively the purview of the president. Over the last 40 or 50 years, Congress has ceded much of the territory on regulating and making rules related to trade policy to the president. So he's got wide-ranging latitude in terms of setting tariffs and other terms of trade with our trading partners. So that just takes executive action. Taxes, just because the Republican administration would like to lower taxes, lower the corporate tax rate, and extend the TCJA to personal tax rates, that can't get done without Congress getting involved. And while we, again, have a majority in the House and the Senate, for the Republicans, it's not that easy. I'll just say this, it is a red sweep, but to actually implement policies here in the United States, you really do need a supermajority or a 60-seat majority in the Senate to overcome Senate Rule 22, the cloture rule. If you don't invoke cloture, stuff doesn't get out of committee, it doesn't get to the floor, and it doesn't get voted on. If it doesn't get voted on, it doesn't become law. So you need 60 seats in the Senate to legislate effectively, with the exception of using the reconciliation process that I note here, which is available once a year and for taxes only. So you can get some tax stuff done with a majority. In fact, you can get a lot of tax legislation done, but it's still going to take some horse trading, and we're not going to hear more about taxes. We're going to hear a lot about them, but we're not going to get anything out of anything substantial out of any of the committees or out of the think tanks until the end of the first quarter and into the summer. But we got to get some tax extensions done by the end of the year, because that's when they're going to expire. So again, you need 60 votes in the Senate. You got a 4-seat majority in the House. It's razor thin. So you don't really have as big a mandate potentially as you thought. And now that we've got the popular vote totaled up and all the numbers are in, it's a couple of million votes, not 6 or 7 million. So the mandate for the new administration is there. Clearly it's a red sweep, but it's not as big as we thought potentially a month ago in the immediate aftermath of the election. You need 20 seats, a 20-seat majority in the House of Representatives. The House is a very challenging legislative body to manage and to corral and to herd some of those members to do the will of the party leadership. So it's very difficult. You need 20 plus seats. You need 240 seats. They got 223 to be precise. So it's not enough. So it's going to be, there are obstacles here. There's plenty of obstacles. We're going to summarize them in a sec, but it's the Senate cloture rule, the lack of a commanding mandate in the House, and some other market-related that are likely, some market-related, like the bond vigilantes, are likely to be a constraint as well. So I'm not going to talk about, you see I've got 4 out of the 5. Here's the 5 that we're going to talk about and what the implications are for growth and inflation. There's a 5th, and that's a Fed independence. I'm just going to take the Fed independence thing off the table and not talk about it anymore, because it's the view of most market participants, particularly ex-bond managers like myself, that is, if there's any move to impair the independence of the Federal Reserve, that first the bond market and then the stock market would riot. So there would be a pullback almost immediately. Again, that's the constraint on some of the policy implementation. It's Congress, the challenge of getting a supermajority in Congress, and the market itself will provide a governor or an obstacle, and also put a hurdle up for some more the less market-friendly policies that might be thrown out there. I don't anticipate the Trump administration doing anything to impair the Fed's independence. I do anticipate that they'll put somebody perhaps more agreeable to looser monetary policy installed as the Fed chairman in a year and a half. But until then, I think we're going to be okay from that perspective. Deregulation, tax cuts, tariffs, and immigration should have either first or second order effects on the macroeconomic environment. And we're just going to narrow things down to what are the implications for growth and inflation primarily. And you've got a little scorecard right here. Deregulation is unambiguously positive for growth for the most part, at least in the near term. It might be challenging for other reasons in the long run, but deregulation is pro-growth. It's also pro-growth policies during a period of time when the unemployment rate is this low. Anytime you're going to juice the economy when you're at full employment, it's likely to be inflationary. I'll just highlight, by the way, and summarize, all of the policies we're talking about here are likely, not for sure, but likely to be inflationary. And that has implications for interest rates and for the Federal Reserve going forward, which we'll talk about. Some of the policies are pro-growth, some of them are less pro-growth, and maybe even negative. Certainly, immigration is likely to be inflationary, or at least put upward pressure, no more disinflation coming from higher immigration and a larger labor pool, which has kept wages under control. By the way, we're going to see a slide in a second. It shows it's very simple tautology. It's an accounting identity. GDP is equal to the growth in the labor force plus total factor productivity. So I'm just going to preview the next slide and say there are a lot of cross currents when it comes to discussing immigration, and setting aside the politically charged view of illegal versus legal. I'm just going to talk about immigration writ large, okay? Nobody's promoting, breaking the law. I'm just saying immigration, labor force growth is a big part of immigration is a big part of labor force growth, and labor force growth is a big part of GDP growth, and it has been highly contributory. The growth in the labor force in the last couple of years has been one of the key components of the Goldilocks GDP we've seen. And the support that we've seen in the economy has come primarily from demand coming from the growth of the labor force. Tariffs, unambiguously inflationary, because other countries don't pay for tariffs. U.S. consumers pay for tariffs. Any increase in the import costs are passed directly on, nearly one-to-one, not quite, but one-to-one. It's inflationary, and it's probably going to be growth dampening. Tax cuts, unambiguously positive for growth. If you got more discretionary income because your tax bill's lower and you spend it, that's positive for growth. But again, these pro-growth policies on deregulation and tax cuts in a period of time when we're at full employment are likely to be inflationary. So summing it all up, moderate positive growth impact, but probably higher inflation. Here's the important thing to note. It doesn't all happen all at once. First of all, there's going to be an order of events when it comes to implementing deregulation, tax cuts, immigration, and tariffs based on whether the president can do so unilaterally with using executive order, or whether Congress needs to get involved. Again, even with a majority in both the House and the Senate, it's going to be difficult to legislate given the razor-thin majority that the Republicans enjoy. Deregulation and tax cuts should increase economic activity. Tariffs and immigration are likely to reduce the labor force and increase consumption from domestic consumers as the domestic consumer producers look a little more competitive given the prices of imports. So what's going to happen first is you're likely to see a growth surge. Unfortunately, the growth surge, as I mentioned, during a period of time of full employment is likely to cause the Fed to pause and potentially even reduce course. If the Fed starts cutting, if the Fed continues to cut rates, you still get a growth surge. Inflation starts to stabilize or bump higher. The Fed's going to reverse the cutting cycle and start hiking rates. And if the Fed starts hiking rates, that's intentionally to put a cap on inflation, but unambiguously higher rates should slow the economy. Although it's really interesting to me that we haven't had a more significant slowdown or even a recession since the Fed started hiking rates almost 3 years ago. Given the length of time since the first Fed rate hikes, and given the distance they traveled from near zero to over 5%, in terms of a federal funds rate, the magnitude and the speed by which interest rates were taken from nothing to pretty restrictive should have caused a recession. And there's one implication I can think of, and that is for some reason the U.S. economy is no longer as interest rate sensitive as it used to be for a variety of reasons. And I think the most important one is everyone refinanced their mortgage 4 years ago, and no one's moving. So what you have is an effective mortgage rate that's substantially lower than the current mortgage rate. The effective mortgage rate in the U.S. is probably less than 3.5%. It's probably 3.5% now. So if you got a 3.5% mortgage, and if you move and you got to expose yourself to a 7% mortgage, you're not moving. New homes now a 7% mortgage. People that are already got a mortgage in 2020, 2021 are going to sit on that mortgage because it's the cheapest money they're going to have. So the point is the interest rate impact on the economy has been muted. We've had this Goldilocks kind of environment, and it doesn't look like that's going to change dramatically, except if we get what I would call the extreme ends of the policy mix that has been promoted during the campaign. I said it before, I'll say it again. What gets said on the campaign trail, these are campaign promises, and they cannot all be implemented. They're there to get elected. They're there to promise all the good stuff and not talk about the bad stuff. No one talks about the debt and the deficit and balancing the budget and raising taxes and cutting services and cutting government expenses in order to balance the budget. Nobody talks about that during the campaign. So I want to stop just for a second because I think we're going to shift gears now into what the implications are for the market. And if you have this kind of an outcome, if the policies that we're seeing, and by the way, we won't know the scope or the duration of any of these policies until we get into it, until the administration takes their seats and the new Congress is installed on January 3rd, and the president and his administration get going on January 20th. But it does appear that it's a fair assessment, at least in general terms, that the policies of the Trump administration are likely to be pro-growth, and they're also likely to put upward pressure on inflation. Whether it causes the Fed to reverse course or not remains to be seen, and it probably won't in the next couple of quarters. So hence our outlook for a soft landing remains. What does it mean for asset prices? Well, pretty clear in a pro-growth, risk-on environment that stocks are likely to outperform bonds. They've come a long way. We saw that in the slides and prior. The stock market is up meaningfully since September 18th. It continues to chug ahead. We've had a couple of sideways days here recently in December, but it does look like there's a renewed sense of optimism about the economy, about the outlook for corporate profits given taxes and deregulatory environments, things of that nature. There's less positive outlook on tariffs and immigration policy as it relates to economic activity. But right now, market participants are focusing on the positives and not just ignoring the negatives related to tariffs and immigration, but also are looking at potentially ignoring completely the debt and deficit related issues, which still loom large, at least for those of us with a longer term investment horizon than between now and next Friday. So the U.S. is likely to outperform non-U.S. That's already happened. There's a lot of that priced in. The U.S. continues to dominate, as we saw on the first slide. How long can that continue? I think there's a lot of reasons to believe that there's some persistence or momentum in the U.S. versus non-U.S. trade. And again, Julian will talk a lot about that in the upcoming section. Credit's likely to outperform. Short-term bonds are likely to outperform long-term, especially if inflation persists. Credit will outperform if we don't get a recession. Almost every policy that the president has articulated promotes a strong U.S. dollar. And we've seen volatility, which spiked just before the election, spiked briefly, and then came back down to historically very low levels. We've gotten past the uncertainty of the election now. And volatility has dampened tremendously as the stock market has continued to go higher. But so to me, the volatility increasing argument is more one of level as opposed to, okay, I can look at something in the future and say that's going to create volatility. So uncertainty is still pretty high on the duration and the scope of the policies. And it does appear that markets are priced for perfection. Julian, did you have a question?
Yes, I guess I'm going to preview again the next few slides, but the question is about the Trump administration policies. How will they affect growth and inflation through immigration specifically?
Good question. Why don't we go right there? So this is an accounting equation we should all just have at our fingertips. Labor force growth in the labor force, whether it's native immigration and through the lens of a labor force participation rate, plus total factor productivity, which is, we have very high productivity here in the United States because we have high human capital, a lot of R&D. We have DARPA, we've got all the kinds of, the Defense Department's research and development area. I mean, the policy environment for R&D is very positive. The technology available here in the United States and the companies that are here producing new technology is very high. So total factor productivity is always going to be, it's cyclical, but it should be pretty high here in the United States. Labor force growth, on the other hand, can be influenced pretty dramatically by policy. And it's the combination of those two things that equals economic growth. So this is an accounting identity. So when you're trying to suss out what immigration can or cannot do for GDP, what you want to note immediately is that there's a plus sign right here. So if immigration growth starts to go lower, then labor force growth will decline. And if labor force growth declines, GDP will decline. To what level are we talking about? Well, some of the policies suggest potentially that while we've seen labor force growth of between 1% and 1.5% over the last couple of 3 years, while immigration has been at near all-time highs, illegal and legal, If you implement the policies as articulated, that could go closer to 0, which would take 1% out of GDP growth. So if GDP growth or potential GDP growth in the US has been over 3% for the last 3 years because of the high level of labor force growth, if you implement some of the policies as articulated, it's going to reduce the potential GDP of the United States specifically through this mechanism. So it's not theoretical. This is an accounting tautology, and so if you can somehow make up for a lower labor force growth by substituting, capital or productivity gains for that labor. So AI could be used on the flip side to make up for the loss of GDP as a result of lower labor force growth. You could see that. So what we're going to keep a close eye on here. And by the way, in the long run, policies generally coalesce around, higher growth rates. So it's pretty well understood. China had an issue with primarily native growth during their one-child policy, and they've completely reversed that now because they've seen that no growth in the labor force is a significant dampener on GDP growth. So you get policies, they get implemented, you see how they go. Thoughtful people then take a look at the implications, and after measuring the costs and the benefits and looking back in time and seeing how they really affected the metrics of interest, which in this case would most assuredly be GDP, sometimes you get a reversal. So, just because we're in this policy environment right now doesn't mean it wouldn't reverse 2 years from now or 4 years from now when there's a new Congress and a new administration. So I don't really get too excited about extreme policy promulgations because they don't get implemented. And if they do get implemented and they produce a negative outcome, they get reversed. So again, it's best not to get terribly wrapped up in the politics of the thing. It's best to do, I think, what we do, which is do the best you can to understand, be in Washington a lot, talk to policymakers, understand what their incentives and the priorities are, understand better the constraints on legislation, and realize that, there's none of this is going to, be the end of the world. There's going to be winners and losers. There's going to be people who are happy and people who are sad. But overall, the economy is going to continue to march along. It just might march along at a lower potential GDP growth rate for a while until the policy is reversed, if that turns out to be the case. I think it's, if you're going to go even deeper into this labor force growth equation, so you've got labor force growth here, and labor force growth is a function of native births, immigration, and then labor force participation. Looking at native growth, immigration, and labor force participation even further, it's important to note we are looking at all of these things and the interaction between these things to try to assess what the outcome is for the economy. The economy's humming along right now, and as long as the consumer stays engaged, and as long as we don't have an exogenous shock, changes in immigration policy will have an impact on the margin for sure. And in fact, net births here in the United States, we're barely not even replacing ourselves now. The dependency ratio, which is the number of folks over 65 versus the divided by youngsters, is increasing. So the labor force is not growing natively by either of those. We're going to see a slide on that in a second, where native growth has been versus immigration growth or foreign-born worker growth. But here in the United States, we've got both legal and illegal. Either way, immigration growth or growth in immigration is contributing to labor force growth, plus no matter what you do. And the labor force participation is more cultural and policy related. So there's a lot of things to consider when trying to parse out the implications, because there's a lot of cross currents. Just because you take illegal immigration is going to decline dramatically. It already has. It was on a downward slope in 2024 post some of the Biden administration summertime border closure executive orders. Legal immigration, on the other hand, is likely to suffer further under a Trump administration, and that is going to likely slow labor force growth and take 1% out of potential GDP in coming years. It's not going to happen instantaneously. So we don't have to worry about this being a recession causing as a shock, because the policies that will need to be implemented to cause damage to our labor force growth metrics, and again, just to be clear, labor force growth is a key component of GDP. They're not going to happen overnight. They're going to take a while to implement. Let's just dig a little bit deeper because there's a lot of questions about immigration and what it means. I mean, since 2020, native-born workers have declined as a percentage of the total U.S. labor force by 3%, where that slack has been picked up by foreign-born workers. And they've expanded the labor supply. This is the argument to suggest that a lot of the post-COVID, economic miracle that we've seen here in the United States, that is labor force growth, which came primarily from foreign-born workers or immigration, has almost completely and maybe completely offset, along with fiscal stimulus and some fiscal accommodation, has completely offset the tightening effects of a 500 basis point plus Federal Reserve monetary policy tightening cycle. So all of that policy tightening came about to put a cap on inflation that was getting out of hand back in 2021 and 2022. Much of it has been overcome by immigration and, frankly, fiscal stimulus because we're running massive budget deficits. By the way, that's a recipe for disaster down the road, but we're not there yet. This just puts a fine point on the growth in foreign workers during Trump 1. Trump 1, 2016 to 2020, you saw a pretty significant decline post-2018 in the growth in foreign-born workers. That reversed almost immediately in the Biden administration, just to show you the differences between the two administrations. Julian.
Question that will preview the next section again. How is the Trump administration planning to finance these pro-growth policies? So what's going to be the impact on debt and deficit, basically?
Increase in debt and deficit. So the Committee on a Responsible Federal Budget, which does a deep dive on the campaign promises and the campaign outline for taxes, and they basically score each campaign, so the Harris campaign and then the Trump campaign's outlook for various policies. And there's a lot of detail on this. Contact me if you want to see it. But if you extend the Tax Cut and Job Act tax rates, if you don't tax tips or Social Security or other areas that are being taxed, if you expand certain other programs that are priorities for the Republican administration, the number is quite large. Right now, the national debt's at $36 trillion. Scoring of the Trump policy priorities suggests it would increase by $7.5 trillion over the next 10 years. So we're not going to have an administration for 10 years, but we will have policies that, if they get implemented, will add nearly $8 trillion, between 6 and 10 trillion, to the national debt. We can handle it. Potentially, as long as we continue to grow. So you can't think about an increase in the debt, which is the right side of the balance sheet, without thinking about an increase in growth rates, because the growth rates are what you use to pay down the debt. So as long as the investments, particularly in investing in physical capital and human capital here in the U.S., if it's for consumption, that's different. But if if the consumer is getting relief on taxes and is buying assets as opposed to consuming, then tax cuts can be positive, because if businesses are investing, tax cuts for corporations can be positive. That was the whole rationale behind lowering the corporate tax rate, is that it would increase R&D and investment, business fixed investment here in the U.S., which would build the capital stock, which would increase GDP in the future and corporate profits in the future. That was the rationale. It didn't quite happen that way, because it almost doesn't. That's not quite supply side economics, but there's the theory behind the original tax cuts. But now you've got them. So now you got to, if you reverse the tax cuts, if for some reason we don't do anything on taxes and every single tax break sunsets on December 31st, 2025, just 1 year from now, it would likely cause a recession, because everybody's disposable income would go down materially. So you're going to get some work on that. But the deficit is really the issue to consider, and we'll talk about that in a sec. These are the slides I always present. It's just a heat map on the right showing various regions of the globe and kind of where they're headed. Right now, it looks like we're kind of just kind of it's yellow, it's not green, it's not red, so it's kind of in between. But here's the JP Morgan Global Services and Manufacturing PMIs, or Purchasing Managers Indices. These are diffusion indices. So anytime you get a number above 50, it means, for example, the services, global service activity is expanding. Global goods activity took a little dip in the second half of 2024, but it's popped right back up, right to the 50 mark, which is neither expansion nor contraction. It's kind of treading water. So goods, most of the, this is a solid number. The global economy looks pretty good. It's maybe a little less supportive now than it was 6 months ago. Things looked a lot better over the summer, maybe, but there's no warning signs in the global growth. In terms of what the central banks around the world are doing, hikes and cuts in the last 12 months, developed economies have seen 5 hikes. EM, they're trying to protect their currencies a little bit. You've seen 11 rate hikes, no rate hikes in the last 3 months for developed, and 4 rate hikes by emerging economies. Mostly the activity has been dominated by rate cuts. So you had both developed and emerging economies in the last 12 months, 60 rate cuts, 120 total between developed and 121 between total and emerging. And here's, by the way, what's happening in the average central bank rate. It peaked in EM at 9.3. It's come down. Things are coming down very quickly in emerging and developed markets, where emerging started earlier back in February 2022. Developing markets started raising rates later, but they did it faster. The slope of this line is much higher than the slope of that line, and it looks like they're coming down much faster too. So DM and EM are both cutting. The rate hike cycle globally is over, and things are moving towards neutral. The rate levels, generally speaking, are high, and on a real rate perspective, are still restrictive. So we're not at neutral yet in terms of the Fed funds rate here in the United States. We're at 4 5/8 right now, mid, and 4 5/8 mid is probably 100 basis points higher than the neutral rate. So you need 4 or 5 more rate cuts before we get back to neutral. We'll talk about that in a sec. But let's go to the debt and deficit. It's a challenging topic, but it's something we really need to be aware of. Right now, if you go to the CBO, the Congressional Budget Office, cbo.gov, it's a spectacular website. Check out their expectations for debt to GDP. By the way, the national debt at 36 trillion is a big number, but what you want to do is compare that to the income that you're earning to pay down that debt, which is for countries, that's GDP. So debt to GDP as a percent is the more important number. We peaked at 126% immediately after COVID because we had all the debt issuance to pay for the COVID mitigation policies and the government mandated shutdown. Then we had some recovery because we had pretty high GDP growth. But the outlook for getting us to back to 100%, which is the bare minimum. I mean, for most of the last 70 years, we averaged 60% plus or minus. We're at 120 or double that. We haven't seen those numbers since World War II. But the outlook from the Congressional Budget Office is that we're going to continue to see higher budget deficits, which will increase the budget debt, the national debt, and likely continue to grow to something on the order that could eventually become unsustainable. We really need to get to 100, but it looks like we're on a path to something over 140 over the next 10 years. Julian.
And maybe it's a good time to address a question we've had in the chat a few times now. It's about we haven't talked about DOGE, the Department of Government Efficiency.
Yeah, no, I don't want to talk about that yet. I don't want to, and here's why I don't want to talk about that yet.
The people want to know why.
I'll tell them why. I'm not so sure what the Department of Government Efficiency can and cannot do. So we're not going to have a strong feeling about that. And having 2 big egos running that department seems like a recipe for disaster. So I don't anticipate that you're not going to see. First of all, they don't have any authority to slash government departments dramatically. They have some authority, or from the president, they have some authority to do that. You're going to see some reduction in costs in the government, whether it's as meaningful as people hope or maybe could be. I don't say should be, but maybe could be. It's not. They don't have a budget. They're not yet a full-blown real government agency. Who knows what they can and cannot do? There's too much uncertainty around DOGE to make any strong comments. Here's what I do know for sure. The total government debt is 36 trillion. It's too high. The interest we're paying on the debt is doubled from 1.5 to over 3%. So the dollars, which is just, the number of dollars in the debt times what our interest expense is, that's the dollars of interest expense, is now over and above what our defense budget is. And that's just crazy. We're paying more interest on the debt than we are for national defense. And we can do that. We can make that happen for a while because we're the reserve currency of the world. But with budget deficits for as far as the eye can see, and that's what you're looking at here, going back to the 1930s. And this is the chart from the prior slide showing debt to GDP at heading towards 140%. The new administration is likely to have to deal with at some point this issue in the next 4 years. How are they going to deal with it? They won't be able to deal with it without a crisis, most likely. You're going to need a crisis. What does a crisis look like? Goes back to the third slide I showed, which is 10-year yields. You saw what happened to 10-year yields when it became apparent that the probability of a Trump presidency was increasing dramatically. The market was basically saying a Trump administration is likely to be bad for the budget deficit. A Harris administration would have been bad for the budget deficit too. But the Trump administration scored by the Committee for a Responsible Federal Budget is like a double. It's like 8 trillion versus 4 trillion being added to the national debt. Neither one of those things is good. But again, these are campaign promises, so it's not likely that a lot of that to happen. This is the issue. We really do need to get the budget deficit under control. This is the CBO's projection. These are forecasts out to 2034. So for the next 10 years, the budget deficit looks to be, and this is a group, by the way, whose entire reason for being is to score and to forecast and to look at the policies that are both in place and potential policies. This is all in place. Given if there's no changes in anything, by the way, this is the projection from the Congressional Budget Office, 6% to 7% budget deficits for as far as the eye can see, and stabilizing at very worrying levels. And this green bit is the net interest expense. So much of the budget deficit, which it didn't used to be that big of a deal during some periods prior to the lower interest rate environment, most of the budget deficit was related to net interest. Then for a long time with very, very low interest rates, the green diminished. But now look what's happening. Not only do we have a primary budget deficit, which excludes net interest, but we have a budget deficit in total, including net interest expense, that is just exploding. This can't go on forever. It can go on for a long time. The constraint on the U.S. government, both printing money at the Federal Reserve, which is a separate problem, and spending money that we don't have and need to issue debt for, which is the budget deficit and the national debt. The constraint is another currency becoming, to the forefront as being a stable, responsible, a currency that's got a little more fiscal stability behind it. Who is that? There isn't one right now. We use the phrase all the time that the U.S. doesn't look great, but we're the cleanest shirt in the dirty laundry. All of the rest of the currencies in the world have somehow damaged their fiscal metrics and their debt sustainability. And we're the reserve currency. We still have the fastest growth rates, the best, deepest liquid tradable government bond markets, ease of doing business, rule of law, all of the things that you need, and the strongest Navy, all the things you need to be a reserve currency of the world, we still have. Julian, was there a question?
You actually just answered the question. You read my mind. It was about the US dollar being in danger, and you just said that clearly not in the short term.
Yeah, it isn't. I'll actually get to the next slide, which has got a lot of data on it. I actually presented it back in August, but I'll present it again because it's a good point. This is the bad news again, and the next slide is the good news. This is the percent of tax revenues that the government takes in that goes to interest expense. And think about it. So we get $100 of tax revenue. For the longest time, about 10 to 15 cents on that went to interest expense. It's now 20%. So we're 20 cents for every every dollar we take in, 20 cents goes out to pay interest expense. And we haven't been in that situation where this percent of interest expense versus tax revenue has been so high. And there's this theoretical policy threshold of 14%. We blew right through that a year ago plus. Now, once you hit 14% tax expense or interest expense as a percent of total tax revenue, you really have to start thinking about more restrictive fiscal policy. It's why this administration is going to have to deal with it, because the amount of money you spend to service your debt, the interest expense that you pay is the constraint. And we saw in this chart, it's just, look, this is the interest expense forecast for the next 10 years. It's the bulk of the budget deficit. And as a percent of tax revenue, it's just incredibly high. You can have accommodative fiscal policy when interest rates are really low. Even if debt's high, if interest rates are really low, you can maintain an accommodative fiscal policy, which we have, and we still do. Unfortunately, those budget deficits that are projected for fiscal 24 and 25, 26, 27, those fiscal deficits mean accommodative fiscal policy. That is a stimulus. That's a positive impulse to the U.S. economy, offsetting the negative monetary impulse. We're in a period of financial dominance now, where the fiscal impulse is overwhelming the somewhat restrictive, now was very restrictive, but now somewhat restrictive monetary policy. So somebody's going to have to, deal with this. We need another Simpson-Bowles 2012, bipartisan commission on how to deal with the debt, which nothing will happen. If it's a committee that's making recommendations, nothing will happen. If the 10-year Treasury yield goes from 4.30 or 4.25, let's just say it's 4.25 today. It's 4.30, I think. 4.25 today. If it goes to 5.25 tomorrow, there's information in that. And the information is the rest of the world and bond investors, including the bond vigilantes, are saying the fiscal dynamics of the U.S. are unsustainable, and you best get your house in order, or we're going to torture you with much higher interest rates. We're going to demand a higher yield to take more of the supply. Every time you ever run a budget deficit, it increases the supply of U.S. Treasuries. So, and increasing the supply without any other changes means the price has to come down on Treasuries, which means the yield goes up. Point is, if you're going to issue a bunch of U.S. Treasuries, you're probably going to have to incentivize buyers with a higher interest rate or a higher yield. And if that's the case, this metric explodes, because now you've got a mountain of debt, interest rates are high, and you get into what's called a debt spiral. And we're not going to do it because we're the reserve currency. Then there is no substitute. So there will be demand for U.S. dollars no matter what, until some other actor makes its appearance on the stage and becomes a credible substitute for the U.S. dollar. There isn't one. We were talking about this. There was a car company that had an advertisement tagline: "There is no substitute." A German sports car company. There is no substitute. There is no substitute for the U.S. dollar. That's why it won't collapse. U.S. dollar isn't going to collapse in a vacuum. It collapses against other currencies. So you have to ask the question, if you think the U.S. dollar is in danger, you have to ask the question, who's going to usurp the U.S. dollar? Which currency do you think will be take on the reigning champion and knock them out? And there isn't one. There isn't one on the horizon, but it's something we're looking at. And this isn't a good path. But here's why. And again, I'm just going to summarize this chart. It's basically the difference between the U.S. growth rate and the interest we're paying on the debt. If the growth rate of the country, if our GDP is higher as a percent, say it's 4%, say it's 3% nominal, by the way. So say it's 5% nominal, that's 2 or 3% total factor productivity and 2% labor force growth. If we get labor force growth, this is the key, by the way. All of these policies have cross currents. All of these policies have implications that are both positive and potentially negative. And that has to be taken into consideration. A full-blown cost-benefit analysis needs to be done when implementing any kind of economic fiscal policy. And fortunately, there's groups that do this, but it's hard to say what's actually going to get done. So know this: as long as growth in the United States, nominal GDP is 4+%, that's going to be higher than the interest rate we pay. As long as interest rates don't spike. If interest rates spike, all bets are off. If market participants lose confidence in the U.S. Treasury market, which they're not going to do because of this metric, our growth rate is high enough right now to maintain our debt sustainability. It's high enough to maintain debt sustainability because growth in the U.S. is higher than the interest expense that we're paying on our debt. That's it. Otherwise, if it was the reverse, that's where you get into a debt spiral. So let me summarize some of these issues that we've talked about, and then move on to the next section. But a lot of what you heard in the last year, it was a long election period. We have the longest election period of any country. I don't know how long is France's, 14 days by 30 days or something by constitution. Mexico, they do elections in less than a month. Every other country does elections in a very compressed time frame. But here in the United States, we have 400-day election cycles. So it's over now. and we can put the election in the rearview mirror. Now we have to think about what policies that were discussed during the campaign can actually get implemented. And again, I just want to highlight there's three main constraints to doing a lot of what was discussed. And the biggest one is going to be the razor-thin majority in the House, and frankly, the market implications of any policy that looks like it's going to be debt negative. The bond vigilantes are itching for a fight, and what I mean by that is the bond managers, the large fixed income managers of the world, and the large reserve managers at places in like China and Japan that own trillions of US dollar debt, including trillions of US dollar treasuries. Those are the folks that are going to determine and put constraints because of their ownership of our debt. They're going to put constraints on the types of fiscal policies that can be implemented. Okay. I'm going to make a couple of comments here, and then I want to turn it over in the next 5 minutes to Julian to talk about U.S. exceptionalism. Going to stop real quick. We're at the hour mark. Any other questions that relate to the things we've talked about already, Julian, or should I keep moving?
I think yeah, we can keep moving. There's a lot of questions, of course, about inflation and the Fed.
Okay.
So it's a good
Let's
time
talk
to
about the Fed then and where inflation's headed. Inflation, you can almost declare victory on inflation right now. Inflation was moving pretty meaningfully lower since it peaked in June of 2022 at 9%. So we've seen the peak of inflation. It's come down dramatically. But the question now is, where is it going? And the answer is we don't know. So before we can declare victory and a soft landing, the Fed has to land the plane. And just about 3 months ago, when we last presented, it was before the first Fed rate cut. We were at 5 3/8. We're at 4 5/8 now on Fed funds. Where are we headed in the next couple of quarters? And where I would have said we were headed towards something like, between 2 and 2.5%. That's the old policy normalization rate. So call it 2 1/4, 2 3/8, something like that. That's where we were headed before. So we had a lot of room to come down. That says to you the Fed is really tight, but that's not the case anymore. The thinking is that interest rates are probably permanently slightly higher, and that we're actually closer to the landing zone, and that we'll probably go to 3 1/4, 3 1/2, something like that. And if that's the case, we're going to be there in 4 more rate cuts. 4 or 5 rate cuts will get us to the landing zone and the neutral rate of interest. Recall in last webinar discussion, the landing zone or the target destination for the Fed has to be R star. R star is the normalized and neutral rate of interest. So the Fed's still circling. They're gathering the data. They're looking at where inflation is. It's kind of stuck now. We got some new inflation data yesterday, which was as expected, which is why the market didn't freak out about it. But it was expected that inflation would not improve dramatically, and it didn't, kind of move sideways. Inflation is proving to be very sticky at around 3%. It needs to get down to 2%, which is the Fed target. But going from 9 to 3 was the easy part. It's this last mile going from 3 to 2 that's going to be very challenging. And again, until we get to until the Fed can lower interest rates effectively to something on the order of 3 or 3.5, we're not going to be able to declare victory on a soft landing. They will not land at the plane. So we're keeping a close eye on that. We're saying Fed has probably beaten inflation. There might be an echo of inflation in 2025, almost invariably, when you have a burst of inflation like we saw in 2021 and 2022. And then the Fed became very aggressive, raised interest rates, inflation came down. Almost in 80% of the cases globally, not just here in the United States, but even outside the United States, 8 out of 10 times you get an echo of inflation. We may be seeing it right now. It may not be too challenging. It may just be stuck at 3 or up a little bit from the 2.9 we were at for a while. And it may last for a quarter or two. Or it may be something more nefarious. That is, you might see a little bump up of inflation. If you do, the Fed's not going to continue to cut rates. But the Fed has beaten inflation, and so they've been trying to take rates down. They're trying to loosen financial conditions a little bit because, frankly, they're now is concerned. It's a symmetrical reaction function for the Fed. That means they're just as worried about unemployment going too high as they are about the inflation rate. So if you're worried about inflation going too high, well, or unemployment going too high, and you feel like you have inflation under control, you're going to lower rates. So pretty soon they're going to be able to declare victory on price pressures. But this is a good I like the game plan chart because it basically describes in very, in detail exactly how the Fed thinks about the world and what asset prices they're trying to affect to move the needle on inflation and to continue to support currently the labor market. This is just more detail on the financial conditions index. Just know this, when the Fed is trying to loosen financial conditions, they only have control over short-term interest rates. The Fed funds rate, the one they're going to lower 25 basis points next Wednesday with near metaphysical certainty. That's our bet right now, is the Fed's going to lower rates 25 bips next Wednesday. That's all they can control. But by lowering short-term interest rates, it affects the S&P 500, the level of the S&P. So it affects stocks. It affects volatility in stock markets, corporate bond spreads, and the dollar's been appreciating. So that's been going counter to the Fed's lowering of interest rates. Stock market's been going up. That's counter. Actually, that's positive, because what that means is as the financial conditions ease as the stock market goes up. And so we're seeing that they were explicitly trying to tighten financial conditions, but they never caused a recession. So they slowed economic growth. Hence, we can almost declare victory. I'm going to talk a little bit about the outlook for growth and inflation now. The consumer has been killing it. This goes back 2.5 years of economic growth. You can see, from the kind of the low at the first half of 2022 is kind of a recession. First quarter, second quarter of 2022, negative GDP prints. But ever since then, it's been Goldilocks, 2 to 4%. And the outlook going forward for GDP looks just like this. That's an economist consensus forecast for you. It looks too steady. It looks too consistent. It looks too Goldilocks. So probably won't be this, but there's nothing on the horizon to suggest that GDP is going to take a hit. There's always some kind of a shock, but there's no imbalances that are obvious to us right now. So kind of Goldilocks looks like it's going to continue, at least for the next quarter or two, as far as we can see. So here's the GDP forecast for the next 6 quarters. Again, Goldilocks-y looking, kind of 2% growth, right at potential. If you're at potential GDP growth, inflation is likely to continue to, eke its way down towards the 2% target. That's the hope. And if that's the case, then the forecast for Fed funds right now is to get to 3.5, 3.6 by the beginning of 2026. So 13 months from now, plus or minus, we should be kind of on the order of 3.6. That's still not the landing zone for rates normalizing. I mean, R star is either 3 3/8, which is obviously below 360, or R stars. The old R star was 2 3/8. So who knows where the neutral rate really is, but this is a very benign economic outlook for growth, inflation, and for Fed funds. And there's not an economist out there that thinks we're going to have a recession. Well, there's 25% of them, I guess. So 1 in 4 economists is all that thinks it's a non-zero probability we'll have a recession in the next 12 months. But very few economists believe that to be the case. Now, 2 years ago, 2/3 of the economic community thought we were going to have a recession, and we didn't. There's been some very strange cross currents in the current post World War II cyclical recovery, things that we've never kind of seen before, and as a result of the of COVID and the policy response to COVID, both monetary and fiscal. So anything the economists can sort of, and to a certain extent, Beacon Point, because we were more in the economic slowdown, protect the portfolios against a recession camp 2 years ago. That's where we were. We can maybe be forgiven because there isn't a historical precedent in post-World War II history for the types of things that occurred in 2020 through 2024. But things seem to be normalizing now, which is good news for economic forecasting. That may take a little bit of the uncertainty out of the picture. But clearly, the Bloomberg survey for first quarter 2024, 2% plus on GDP growth, all of the indices that suggest that there might be, some surprises. Economic surprises are positive now. All the data is coming in higher than expected. So again, there doesn't seem to be anything to knock this run of resiliency off the charts. So we always show this chart, which is the heat map as of November. We're looking at inventory levels, leading economic indicators, financial conditions, and consumer and home builder sentiment to try to get a sense of where we are. This little surprising red blip was the first week in November, right ahead of the election. You had a spike in in equity volatility. But other than that, there seems to be a fair bit of complacency in markets. Stocks are continuing to rise. Corporate bond and high yield bond spreads are very, very low. And there doesn't seem to be any warning signs on the horizon. Again, this was a one week blip that's causing this little red flashing light, so we can safely ignore it. Again, the most important thing we can do as investors is figure out where we are in the business cycle. So with Nick Coletta's help, our new research associate on the investments team, we've been able to take all of these data points here and plot them on the on a stylized business cycle. I mean, where are we now? I don't know. You know, this is from 90 days ago. I mean, I would take this economic growth line, which shows us kind of into a trough and maybe into, you know, non-positive economic growth, and move it down here. Just move it down, because it doesn't look like we're going to have a recession. Doesn't look like we had a recession. But here's kind of where these data points are. They're kind of aggregating. There's some that are peaking, some that are troughing and coming out. I mean, all of the financial conditions are looking in pretty good shape. The yield curve still flat, suggests maybe there's some trouble on the horizon, but the yield curve has been a poor predictor of a recession now for 2.5 years. So looking at all of this thing, taking it all together, you know, we're certainly not in a recession. We're probably in an exaggerated or an extended mid-cycle environment. Not going to talk about labor because we want to get to the U.S. exceptionalism piece. But the labor report from last Friday was a big rebound from the prior. So not a lot of concerns. A 4% growth in average hourly earnings and a 4.2% actual unemployment rate. These are signs of, you know, this is not a huge concern. This needs to come down to something with a 3 handle would be better. So 3% average hourly earnings growth. Average hourly earnings growth is now above inflation pretty meaningfully. So real wage growth is supporting the consumer. If your wages are growing faster than prices are rising, which for the economy as a whole is true, not for everybody, but for the economy as a whole, things are okay from a real wage growth standpoint. And with unemployment, again, just a half a point away from 50-year lows, that's still pretty strong labor market. I'm going to skip some of the more labor market stuff. Again, there has been some cracks in the consumer in terms of consumer loan delinquency and credit card delinquency loan rates, but nothing too much to worry about. And just going back to, you know, headline and core inflation, to put a fine point on it, this number peaked at 9.1%. That's the peak here, but we're down to something that's kind of in the yellow zone here. We're not back to green, and we're certainly not flashing red. So still above the Fed's 2% targets, but things seem to have stalled. So we had a report yesterday. The next one's coming just before our next or around the time of our next asset allocation and macroeconomic committee meetings in the first part of Jan. But I mean, this needs to come down a little bit. And just to look at just to some momentum, Jay Powell hasn't talked about supercore lately. Supercore is core services ex housing. Housing, you know, has been a thorn in the Fed's side in terms of prices. It's been very sticky. As it stands right now, supercore is at 4.5, well above what the Fed needs to see, something closer to 2. But the momentum's moving in the right direction. So the year-over-year number is 4.5, but 4.3 for 3 months and 2.3 for 6 months. So the momentum is down. Same with PCE core. The year-over-year numbers and the 3-month number are exactly the same. So there's not a lot of anything to say there. Finally, I just want to talk about Fed funds for a second and then turn it over to Julian. 95% chance of a Fed rate cut next week. That's why my prediction isn't that bold of a prediction now. And if you do get a cut next December, not next December, but next week, between now and next December, we're expecting 2 to 3 more, probably most likely 3 would be my guess for 2025. So, and that will take Fed funds down to 3 3/4. So let me just summarize all that and turn it over to Julian to talk about international equities for a sec. The summary of the outlook is this: near trend growth, inflation to stabilize at higher levels, because higher inflation levels are actually pretty good for liquidating the real debt burden. If you have higher GDP, nominal GDP, because inflation is higher, you can pay down more debt. So the Fed is incentivized to leave it to not take inflation below 2% or even down to 2. So I think the Fed's going to be happy and declare victory on inflation if it gets below 2.5, stays above 2 and 2.5, so around 2.25. So that's the 2 or 3 rate cuts we're going to see in 2025 after next week. So you've had the political uncertainty removed, but there's policy uncertainty that remains. We don't know what's going to get implemented to the degree or the scope, and how much can get done in a constrained Washington, D.C. and a constrained market environment. There is no mandate per se. It's a red sweep, but not a mandate to the playing field has not been cleared. So you're going to see some hurdles thrown up in front of the administration when trying to enact some policies. But along the major policy priorities, immigration, trade and tariffs, regulatory policy and taxes, you're going to see a lot of changes, but a lot of that's already priced into the market. So in terms of like, how do you position the portfolio for the new policies? It's already positioned. It's always already positioned. I mean, we're already looking, we knew what the policies were going to be. We get a little bit of inflation, we'll nudge the portfolio into some inflation protection, hopefully before the fact. That's the key. If we're talking about right now policies and what the implications are for markets, it's already priced in. So there's no need to hedge or do anything dramatically different in the portfolios. They're built to weather the storm and to get what the market's offering you. It's a fool's errand to try to predict exactly which markets are going to go where on a quarter by quarter or a year over year basis. Just know that over 3 to 5 years, stock market's likely to go higher. Bond market's not likely to go dramatically lower. The U.S. economy is likely to steam right along. And if you have a long-term investment horizon, you should stay invested. Where should you invest, Julian? Exactly. How about that? How about we go there? Turn it over to you for the next 5 or 7 minutes, please.
Thank you, Michael. Yes, I guess we still have a few things to cover, and with 20 minutes left, I'll try to be quick on the paper. So it's available. It's about 30 pages. So if you want more details, please go online. You'll find it on our website. It's also on social media. It's called US Exceptionalism, mais bien sûr, which means but of course in French. And I guess the conclusion of the paper, what I'm trying to say here is that the US market is indeed exceptional, but it's also reflected in the price of the US market. And so if you you need to think about the opportunity set in public equities. And basically, the US is about 65% of the global equities. So if you're an institutional investor, you're going to look at ACWI, or what we call ACWI is the All Country World Index, as the 100% of the opportunity set, which means 65% US, about 25% other developed markets, or what we call EFA, and the emerging markets is the last 8-10% basically, and that's the opportunity set. Now the question is, how do you optimize portfolios to get the best risk-adjusted returns? And the conclusion of the paper is that this has changed because the indices have changed, because valuation have moved and correlation have moved. So it looks like today there's a lot less benefit from a diversification point of view in having developed market exposure. There's still some benefit, and there's more benefit to having some emerging market exposure. And that's one of the conclusion of the paper. And then looking at valuations, basically, that's the other main reason why you would want to own non-US equities. And again, Michael, if you want to go to the next slide, basically, what I'm showing is that basically what it means owning US or non-US equities. They are really a vehicle to exposure to businesses. And when you own US equities today, you own a lot more international exposure than 20 years ago. So for instance, the international exposure to the S&P 500 went up from 27% to 40%, and it's actually almost 60% in some of the growth sectors. So you do get some international exposure by owning the S&P 500. If you go to the next slide, please. So what's very different as well between US equities and the rest of the world is the sector composition. And that goes a long way into explaining US exceptionalism. Basically, you can see from the graph here that there's a lot more exposure to growth sectors in the US. Like look at the S&P 500 has more than 30% in information technologies, while Europe is an EFA and emerging market are have much more exposure to financials and industrials that are more like lower growth sectors. So that goes a long way into explaining why the US is growing so much faster. And you can see that in the next slide, where we're showing the earnings growth by region. So if you can, yeah, so you can see basically, and that goes a long way into explaining why the US is doing so much better. Basically, the CAGR for earnings in the US going back 20 years is 11% almost, when for IFA and EM, it's closer to 1 to 2%. And so, of course, valuations are discounting mechanism of future earnings. So the fact that we're trading at such a higher multiple in the US are justified by the earnings power of US equities. US companies have just done a much better job at growing earnings. And that explains the valuation differential. Next slide. I think in the next slide, I think we're showing as well again that US basic companies are exceptional from a fundamental point of view. Yes, because they are just better steward of your capital. They have better return on equity, better return on assets. They're just doing better job at investing capital that they receive, and that's reflected in the two graphs that you can see here. So I guess we can go to the next one. We don't have much time for that one, but basically the conclusion that yes, US equities are exceptional, but it's also reflected in the valuation. So we're showing here the PE ratios, price to sales and price to book ratios, and in the blue line is the S&P one, and you can see clearly US or S&P as a proxy for the US trading at much higher multiples than IFA and EM. So that's a reflection of future growth being priced in the multiple. So that's, I guess, the risk of getting involved in something that's exceptional at 27 times PE now. So the other reason that's usually in modern portfolio theory that we use for the main reason for owning international non-US equities is diversification benefit. And you can see from this graph that the correlations are on the rise, in particular for IFA, the IFA region. So it used to be in a 0.5 range, and now it's closer to 0.8, 0.9. And so the less with higher correlation means less diversification benefit. So less benefit to owning IFA to diversify your US portfolio, US equities. The next slide will show that actually EM, emerging market, offer better diversification benefit. So that would be here. You can see I guess purple line is showing a 0.74 average in the last 20 years as opposed to 0.85 for IFA. So basically emerging market is a better diversifier to your portfolios when you want to own non-US equities. That would be the conclusion from a diversification point of view. And then here just a table, and there's a lot more data in the piece that was published, but just a table to show basically that what really matters is, at the end of the day, is time in the market, and of course the longer you invested, the narrower the probability of outcomes. And so you can see highlighted in blue, we are showing US, IFA, and EM for 20 years of compounding, with the average for the US and median being about 8%, with a standard deviation of 1.4. IFA is more around 5%, with a standard deviation of 1. So not very volatile, but much lower, like 3% less return on average over 20 years. So that's a big impact after 20 years. And you can see emerging markets is almost as good as the US, but with higher standard deviation. So EM can have really good years and bad years, and it's going to be more volatile. And so I guess this is showing you that looking back 20 years from a risk-adjusted basis, so basically return divided by volatility, US would have been the best place to be. Of course, it all depends on the entry price, the way you enter, but that's one of the conclusion of the paper.
Thanks for that, Julian. Honestly, you put a lot of time and energy into this. Nicoletta helped with some graphs, but most of the work, the heavy lifting, was done by you over the last 3 or 4 months. You've been promoting a US exceptionalism position, and it's worked out. So appreciate you putting that out there. It's on the website. Check it out. Any questions, don't hesitate to reach out. We're going to have to rush now into the, go ahead, Julian.
Final comment. Actually, I wanted to ask a question. That was the first one on the chat, and that's related to the paper and what we do is international equities. And I was really regarding, are we planning to dial back on international exposure in our strategy portfolios, or what's basically, how do we think about it these days, given the paper and the valuations?
Oh, well, if you're asking, I mean, you know, too.
I know the answer, but maybe they want to hit from you.
The answer is if at least in the near term, and particularly with some of the policies that we're likely to see implemented in 2025, that the momentum behind U.S. exceptionalism seems pretty well established and is likely to persist. The reason perhaps to consider looking at non-U.S. is when the U.S. dollar is likely to turn around, which would be a tailwind to international investing. But all of the signs point to higher for longer interest rates here in the United States, which is one of the larger drivers of U.S. dollar versus other trade partner currencies positively. So I mean, to summarize it, we're likely to, in strategy portfolios, the strategic allocations will remain exactly the weights of the opportunity set, which for a 70-30 portfolio is about 20% international versus 40% plus or minus US, and 10% funding the alternatives. I mean, the most important thing is asset allocation. And over longer periods of time, it's not really a horse race between international equities and US equities. That's not what it's all about. It's the diversification argument. And I think Julian has made a very persuasive case that EFA, or Europe, Australia, and the Far East, Australasia and the Far East, are not providing the same kind of benefit as they had 30 and 40 years ago. So yes, we're likely to be modestly biased to US. And there are some portfolios that we can build that are US biased by definition, that have a different, what I would call, strategic weight. But no, for institutional clients, and our best thinking remains global opportunity set, but it's not. But this thinking, the paper will inform our thinking on when or where to go overweight international, and the hurdle's gotten higher, I think, is how I would describe it.
Yeah. Michael, I was going to add, we already presented the conclusion of the paper to the committees back at before the Q4 meeting. So we're already overweight US and pretty much neutral emerging market and underweight EFA based on the conclusion of the paper. But we're not likely to go to introduce a lot of tracking of all, because we just want to stay close to the benchmark.
Correct. Yeah, I mean, all in all, I think the conversation today is, there's been a lot of discussion about policies, but it should come back to how we're positioning portfolios, because our main mission in life isn't to be, produce content for macro discussion. It's to actually make money for clients. So for the next quarter or three, it's likely that this momentum in value and in quality stocks, or not value, but in quality stocks, is likely to persist. We think value is likely to outperform. It's been a tough fight in the last 30 days between value and growth, but clearly growth has dominated over the last 1 and 3 year performance. But that can't go on forever, we don't think. There's likely to see a rotation. Large caps likely to continue to outperform small, although small has these bursts of spectacular performance, which puts them back on our radar screen. But over longer periods of time, without a recession, small caps could do quite well. But if we get an economic slowdown, defensive positioning in large caps will win out. We've already talked about US versus non-US. Fed funds going lower, but the most important thing we can do is make sure that we have a strategic allocation to those types of investments that have durable, higher expected returns and durable, lower volatilities. And that's just another way of saying, get your exposure in equities in private equity, get your exposure in bonds in private credit, get some exposure in real estate, not in REITs, but in private real estate. So alternative investment vehicles can be and should be a significant component of every client portfolio. Julian.
Yeah, and I was going to specifically ask about some asset classes. So there's been a question a few times about gold and crypto again, given where Bitcoin is trading. So is there room for crypto now in asset allocation, and also maybe a bit more on the alternative investments?
Gold's hard because, but Bitcoin is easy. Gold is a hard one because sometimes it provides the type of inflation hedge that you're looking for. Sometimes it's almost always provides the geopolitical risk hedge that you're looking for, but these are very difficult things to time. So we don't have we certainly don't have a strategic allocation to gold because it doesn't provide any income. It's a zero, earning asset, which is why when interest rates are higher, gold tends to suffer. But as interest rates come down, the lack of a return or of a yield on gold becomes less of a hurdle. Bitcoin, I can't pick the winners and losers in cryptocurrency, so no. And we didn't get any questions about crypto in 2022 when things were down 70%. Investing in crypto, in my opinion, remains relatively speculative. And until we can figure out what crypto's blockchain technology is a winner. Who the winners and losers are in terms of which coins are likely to come out on top 3, 5, and 10 years from now, I don't know. And in the meantime, I'm perfectly willing, and so should everybody else, to leave the volatility of Bitcoin alone and out of the portfolios. It's not going to be a part of our strategy portfolios because we can't make any determinations about whether it's trading rich, cheap, or fair because there's no fundamental anchor for it or intrinsic value for it. And until there is, it's not to me and to our team here at Beacon Point, it doesn't rise to the level of an investable asset. It has to be something we can say is trading. We understand why it's trading where it is, and frankly, if it's rich, cheap, or fair. That's what I would say about it. So this is a summary, by the way, of the portfolio positioning, everything we've talked about. The key here, of course, we're taking a little less bond market risk, taking a little more equity market risk because there is some optimism that the momentum we've seen post-election is likely to continue into 2025. And there doesn't seem to be any icebergs. We're not seeing any obvious icebergs on the horizon. And finally, for our private clients, I'd like to leave these timeless investment lessons. Just remember this. I mean, you got to take a long-term perspective. You got to be diversified. You should have a significant allocation to alternatives and really focus on portfolio investment results versus what's actually happening and what the market's offering you. Another way of saying that is we're going to manage the portfolios like institutions manage portfolios and try to achieve a risk-adjusted return versus the opportunity set that corresponds to your risk profile. That's the benchmark. And know this. Some of the things that I talk about to clients one-on-one or when I'm out on the road, and I'm on the road today in the Memphis office, thanks to Jay for providing a studio for me to present from today, Jay Healy, our head of our Memphis office. But we just had this conversation this morning. Risk management is absolutely essential. Risk management is what differentiates an institutional investor from a non-institutional investor. And it's the focus of our attention all the time. So identify what your objective is, make sure your advisor is building a portfolio that meets your objective, and know that there's going to be volatility in the market. It's going to be volatility. Markets are going to go up, markets are going to go down. We've had 2 great years, by the way, a couple of 20+ years in the equity market, not too much damage in the bond market. 60-40 portfolios have earned 15% plus or minus in the last 2 years. Give me 15% year in and year out all the time. Not going to happen. So we are going to see some kind of a pullback. We're going to see some kind of a downturn in markets, possibly in 2025. Don't know. Depends on the macroeconomic and policy developments. That's all. It's what it's all about. But know this: we're laser beam focused on trying to figure it out, and we're going to protect the portfolio's downside and capture what the market's offering you without taking uncompensated risks the best that we can. So vol is the price you pay to build wealth, and we're hoping that you'll continue to let us help you in that journey. Final comments, Julian.
I guess we're reaching an hour and a half, so it's probably time to close this call. I'll try to answer some of these questions we are unable to answer privately. So thank you, Michael, and everyone. Please look out for our invitation in your email inboxes for our next quarterly macro market update, and that will take place on February 13. So see you all next time. Merry Christmas and à bientôt.
Happy holidays, everybody. Thanks for joining the call. Bye-bye now.